Welcome to the deep dive. Today, we're really digging into something critical and, frankly, pretty shocking about corporate financial health.
We are. We're looking at this fundamental truth that, well, that massive scale and huge sales numbers mean absolutely nothing if you don't have sustainable profit underneath.
Exactly. And to do that, we are dissecting the collapse of a true titan, General Motors.
I mean, just think about it for a second. GM was a global powerhouse. At their peak, they were selling, what, over 9 million cars a year.
Yeah.
And yet, decades of, let's just say, flawed financial thinking completely wiped out their entire history.
How does a company that big just fail? That's the question we're tackling. We're going to lay out the core financial rules for measuring real income.
And then use GM's story as the ultimate cautionary tale. It's a story all about one concept, recognizing your expenses. Or in their case, not recognizing them.
A time bomb that just kept ticking until 2009.
It really was. And to understand the explosion, you first have to understand how accountants even define profit in the first place.
Okay, so let's start right there. When you look at a company's financial report, you see net income at the bottom line.
Right.
But if you're trying to figure out if a company is actually healthy for the long run, net income, it can be misleading. You really need to look a bit higher up to something called income from continuing operations.
That distinction is so crucial. Net income includes everything, the good, the bad, the one-time windfalls, the one-time disasters, but income from continuing operations, or ICO, that's the best measure of sustainable profitability.
So why is that distinction so important?
Because it cuts out the noise. Think about it. A company sells its headquarters for a huge gain. That hits net income, makes the quarter look amazing.
But they're not going to do that again next quarter.
Never. Or the opposite, they have a huge one-time loss from some lawsuit. That tanks net income. ICO gives you this clean signal. It shows you how the core business, the actual engine of the company, is performing day in and day out.
So for anyone looking to invest or even just understand a business, you're asking, what's the recurring money coming in and what are the recurring costs going out? You need that consistent picture.
Precisely. And that's why analysts love the multiple-step income statement. It's designed to let you peel back the layers.
Yep.
You see gross profit, then operating income, and then you get to that clean number, income from continuing operations.
And all of this, every transaction, ties back to that foundational equation, right? Assets, liabilities, plus equity.
It's the bedrock. Every single decision GM made eventually flowed through to that equation, changing their revenues or their expenses.
Which brings us to timing, the recognition principles.
Right. Revenue recognition is pretty straightforward. You book it when you deliver the value. But the GM story, the whole catastrophe, it all hinges on the other side.
Expense recognition, the matching concept.
The matching concept. It's the golden rule for honest accounting. You have to record an expense in the exact same period as the revenue it helped create.
So if you build the car in January but sell it in April, the cost of building it gets recorded in April.
Yes. You match the cost of the sale. If you delay recognizing that cost, you're lying about your profit.
And it doesn't just mislead investors, right? It has to corrupt your own internal decisions. You think you're making money when you're actually losing it on every single sale.
It's a reality distortion field. You might cut your prices thinking you've got this fat margin to play with, but that margin is a ghost.
Right.
It's already been eaten by a future cost you're just pretending doesn't exist.
A distortion field that, for GM, lasted for decades.
Let's look at that history, because it's such a paradox.
Yeah.
GM starts out, founded by William Durant, and it's chaos.
Yeah.
Just buying up companies left and right. So unstable, he loses control.
But then comes the stability. Pierre DuPont and Alfred P. Sloan, they bring in real financial sophistication. Sloan's strategies were, legendary.
Oh, absolutely. Decentralized management, the brand cast system.
Yeah.
You start with a Chevy and you work your way up to a Cadillac. The whole idea of the model year.
And here's the kicker, the deep irony. Sloan implemented the DuPont system of financial control. This was like the most advanced analytical tool of its day.
You have to stress that. They were, arguably, the most financially sophisticated industrial company in the world. They had these precision instruments to track every single penny. Inventory, margins, asset use, down to the decimal point.
So they have all this brain power, all this analytical rigor, and yet the lesson of their downfall is that market share is not profit.
Not at all. Despite all that internal control, the company was fundamentally broken. The numbers are just staggering. Over a 24-year period, GM's cumulative losses, They exceeded $60 billion.
60 billion, that number. It wiped out all the profits the company had ever made in its entire history.
Just let that sink in. They get to their 100th birthday, and their lifetime profit is basically zero or less.
It's a perfect, brutal illustration of what we said at the start. It doesn't matter how big you are. If your income from continuing operations is broken, that scale just makes you fail faster.
Right. Every car they sold just multiplied the hidden loss until it became this insurmountable mountain of debt that led straight to the 2009 bankruptcy.
Okay, so let's get into the time bomb itself. What was it? What killed General Motors?
Well, it was this disastrous mix of a bad business decision and some really bad accounting rules that enabled it.
Okay, so what was the decision?
Instead of paying higher cash wages, which they would have had to expense right away, management made these incredibly generous promises for retiree health care.
Kicking the can way, way down the road.
Decades down the road.
Yeah.
And the thing that let them do it, the contributing factor, was the pre-1992 accounting standard. This is the heart of the whole mess.
Explain how that worked or didn't work.
Okay, so a worker builds a car in, say, 1985. They earn their cash wage, let's say $20 for the hour. The company records a $20 expense. Simple. But in that same hour, the company also promised that worker health care for life after they retired, a massive future cost. Under the old rules, how much of that cost did they record in 1985?
Let me guess. Zero.
Zero. Nothing. Because no cash was paid out for that promise that year. So they just created this enormous liability, completely off the books.
And that created this totally false sense of security. The income statements looked great. Profits seemed way higher than they were.
It was a phantom profit. The true cost of that labor was hidden. The estimates are that it was an extra $1,500 per car.
Wow. So every car that rolled off the line had this hidden $1,500 cost attached to it that should have been matched against the sale price.
Yes, but it wasn't. It was invisible.
So management might see a profit of, say, $2,000 on paper.
When the real economic profit was maybe only $500 or even negative. But they're making decisions based on the $2,000 number.
Which corrupts everything. Pricing, union negotiations, everything.
And that silent liability just grew and grew and grew. Then, the reckoning. After 1992, the accounting rules change. They force companies to actually recognize these promises as liabilities.
And the curtains pulled back.
Completely. Suddenly, GM has to put an $80 billion promise on its books, an $80 billion IOU that it had no way to pay.
And that visibility just shattered the whole illusion. It proved they'd been selling cars for decades without actually charging enough to cover the true cost.
It's the ultimate failure of the matching concept. And it's what led directly to the bankruptcy and all the pain that came with it for those retirees.
This whole tragedy, then, is maybe the best argument for modern accrual accounting.
It really is. Accrual accounting is. It's about getting to the economic truth. It's not just about when cash moves. It's a refinement process. It turns raw data into a real measure of performance.
Give us a simple example.
Okay, imagine a consulting firm. They sign a $20,000 contract in December. They do all the work in December, but the client doesn't pay them the cash until February. On a cash basis, December looks like a total failure, zero revenue. But accrual accounting says, no, you earned that $20,000 in December. You record the revenue then, because that's when the economic activity happened. It gives you a much better picture.
So this brings us to what makes an accountant's job so hard. It's this conceptual challenge. Business itself it's continuous, like a long horizontal bar of activity.
Exactly. But financial reports, quarterly, annually, they're these arbitrary vertical slices that we cut through that bar.
And the accountant's job is to make sure that slice is an honest representation of what happened inside that slice of time.
Which requires judgment and estimation. This isn't just bean counting. They have to look at a half-finished deal, a partially built car, and make a reasonable estimate of the profit or expense tied to just the part that happened this year.
Which is exactly what was missing in the GM case. That car sold in 1985 wasn't just an exchange of labor for wages. It was labor for wages plus a 50-year promise of benefits.
And proper accrual accounting, the matching principle, would have demanded they estimate the value of that 50-year promise right then and there in 1985.
And book a piece of that cost against the car's sale price.
If that had been mandatory, that $1,500 per car cost would have been visible from day one. Management would have been forced to see the truth. They would have had to fix the strategy before the $80 billion bomb was even built.
So after all this, the takeaways for anyone listening seem really clear. First, if you want to know if a company is truly healthy, look past the bottom line. Look for that clean signal from income from continuing operations.
And second, remember what accounting really is. It's not a perfect science. It's a sophisticated estimate of economic performance. Its purpose is to give you a realistic picture, and that realism is what matters for survival.
And you can't possibly forecast a company's future if its present is built on a lie. If the accruals are wrong today, any prediction about tomorrow is basically worthless.
Which brings us to a final provocative thought. We talked about the irony of Sloan and the DuPont system. GM had this incredibly sophisticated internal control system. The shift to proper accounting came too late for them. So it raises this question. If mandatory transparency had forced GM to recognize that $80 billion liability decades earlier, would their own internal system, the DuPont analysis, have been enough to sound the alarm?
Could the system have saved the company if it had only been fed the honest data from the start?